Hi everybody, welcome back. So here's what we're going to cover in this lesson. First of all, why profit isn't actually what we all think it is. We're going to look at a smart way that you can put a value on your micro or small scale business. We're going to take a look also at a 3-step process that's going to give you the best possible business valuation. And lastly, how you can easily justify that valuation to an interested party. Okay, so first of all, I want to tackle a commonly held belief that a business is valued by taking the profit and just simply applying a multiple that applies to a specific industry. So I want to stop you right there and let you know that profit, as I mentioned, isn't actually as valuable as we all might think. And this kind of goes against, what many of us have always believed, but it really is true. And the reason for that is that profit or profitability is something that's very much open to interpretation. You might say it actually doesn't have a really significant meaning. And when you get to the point that you want to know how much your business is worth, what you need to do is start using a very specific methodology, one that's universally recognized. And once you start using a very specific methodology to value your business, it's going to make it a whole lot easier for you to know exactly what you need to do from that point you're at to get the value of your business to a specific target value, and also to really closely track your progress. So you're going to find it really, really valuable to do this. And it's going to give you the best possible chance of reaching that I guess you could call it that value goal. And the main reason that profitability of your business can be very much open to interpretation is that it can be impacted really dramatically by things like how much you pay yourself, or by the car that you drive, or by the office space you work in, or by the number of employees that you bring into your business. So many different factors, the travel expenses that you run through it, and so many other things. So you really need to take a different approach. And now, before I dive any further into this module on valuing your business, it's really important, and I want to be really clear on this. You can give your business any valuation you like. Nobody is going to tell you what you can value your business at or what valuation you can put on it. The really important part is for you to be able to justify that valuation, the justification that you can give for the valuation you put on your business. That's what's really important. Having really compelling reasons to support the valuation that you and or your business broker give your business. So in this lesson, I'm going to teach you how we valued my business and how it works so well for us, and why I think it's the smart way for anyone to value a micro business or a really small scale business. So I'm going to introduce you to these two terms, Ebitda and Pbitda, and we're going to break them down together and learn why they're so important when valuing your business. So Ebitda refers to the earnings before interest, tax, depreciation, and amortization. And Pbitda refers to the proprietor's earnings before interest, tax, depreciation, and amortization. So what do these actually mean? Oh, and before we go on any further, if you've never heard of this term amortization before, don't worry about it too much. It didn't really apply to my business, and it won't apply to many small service businesses. And it basically means to spread payments over multiple periods. So we use it to talk about namely two specific processes, the amortization of loans and the amortization of assets. And what it really refers to is kind of allocating the cost of an asset over a period of time that is not tangible. So if you've got an asset and that asset or that loan is costing you something, well, it's a way of identifying the cost, I guess the intangible cost of that asset. We don't know exactly what that's going to be, and allocating it over a longer period of time. But don't worry too much about that. It really didn't apply to my type of service business. Okay, so why would we use Pbitda to work out what a micro or a small scale business is worth? Well, the reason is that an investor or a purchaser, or someone that's wanting to explore a merger opportunity, really wants to know exactly how much cash is being taken home, how much cash is going into their pocket at the end of the month, or at the end of the year, or the end of the quarter. Therefore, they want to see the owner's or the proprietor's earnings added to the bottom line to get a really clear picture of the profitability of the business. Okay, so when we're talking about Ebitda, what we're actually talking about is Ebitda, earnings before interest, tax, depreciation, and amortization, plus the wage of one owner, one proprietor's wage. And the objective is to find a more accurate estimate of the business profitability, how much the business is worth, by taking into account that owner's wage, how much they're paying themselves. So to work out what a micro or what a small scale business is really worth, Ebitda is the way to go. An investor or a purchaser or someone that's exploring a merger opportunity really wants to know exactly how much cash is actually being taken home, what's going into their pocket at the end of the month or the end of the quarter or the end of the year. Therefore, they really want to see that owner's wage or the proprietor's earnings added back. So for some context, it's a really good idea for me to let you in and show you how my business broker and I arrived at a value for our business, MPT. So I'm going to show you the 3-step process that we use to arrive at the best possible valuation for our business. So the first thing we did is to take a look at the last 3 years' numbers. So as I've mentioned to you already, an interested party, an investor, a potential purchaser, they're going to want to see 3 years worth of numbers. That is the general rule of thumb. So the important thing is how you present those numbers and what kind of value you place on the numbers from each of those 3 years. So let's use an example. I'm going to show you how we did this in just a few minutes, but let's use an example. If the year is 2017, well, you want to be showing an interested party your numbers from 2016, your numbers from 2015, and numbers from the current year, or it might be, if it's early in the year, projections for the current year. You know, you might go a little further back. If your numbers are really impressive back in 2014, you might want to include those, but the general rule of thumb is 3 years of numbers. They want to see your business performance over 3 years. Now, what you do with those numbers is the important part. You can, depending on the way it's going to present your business in the best light, you can look at a 3-year straight line average, which means taking your numbers, your Ebitda, and again, I'm going to show you some actual working examples of this. You can look at your numbers and you can divide those 3 years by 3 to come up with an average for the 3 years. A second alternative is a weighted average. So let's say your performance in the last year has been really, really great. You've been building towards a breakthrough year. So 2016 is looking like a really, really good year. 2015 was a very good year and really built upon a solid year in 2014, which wasn't as impressive. Well, you might argue that the current year is more valuable because that is a true indication of where the business is going. So you might weight that average as 50% based on the current year, 30% based on last year, and 20% based on 2 years ago to come up with a more impressive average, which rewards your performance in the most recent year. Or you might be able to justify confidently that so many special things have happened in the last 12 months based on all of that hard work and those things that have happened in the years before it. And that where your business is right now today is what matters, because it's only going to grow from there. So you might aim to justify your decision to base a valuation only on this current year's numbers. So you may make a decision to justify a valuation based only on this current year's numbers. It's completely up to you. It's your ability to justify your decision and how you came up with a valuation, which is the important thing. So there's 3 options, and it gives you scope to arrive at the best possible valuation for your business using those 3 different methods. But of course, you need to be able to justify your decision to do that. So to reiterate, an interested party is going to want to see 3 years worth of numbers. If you think 4 years or 5 years presents a better, stronger case for your valuation, fantastic. But if you're only going to show an interested party a year or 2 years worth of numbers, they're going to ask to see what's happened before that. So it's best to sort of come clean straight up front. Okay, so the next part of the process, what you're wanting to do is value your business in as many different possible ways as you can to come up with the best possible valuation that you can justify. So you might look at it as an asset-based valuation. Now, for my business, it didn't really apply. Let's just to use a bit of an example for you. Let's say you've got a delivery company that turns over $1 million a year. Their gross profit margin is, let's call it 40%, and they are making a $600,000 profit per year, but they own $3 million worth of trucks. So that, of course, is going to seriously impact the valuation, because you're not going to want to sell a business for $1 million that is holding $5 million worth of equipment. So you would look at it as an asset-based valuation. I'm not going to dive too deep into that here. The next one would be a market-based valuation, and that in essence is looking around at similar businesses and justifying a valuation of yours based on what's happening around you. Well, that's just the way it is. That's what a business like this sells for. It's what the market dictates, and there's a myriad of examples around me of businesses like mine doing the same kind of profit, the same kind of revenue, selling for X amount. So the market dictates that a business like this is worth X amount. Now, the next one is an earnings-based valuation, which is what we've been discussing here. I calculate the Ebitda of a business, the proprietor's earnings before interest, tax, depreciation, amortization, arrive at a multiple based on a range of factors and come up with a valuation based on that. But you should absolutely be giving your business a market-based valuation as well, because you want to arrive at numbers from as many different angles as possible, because you just want to be giving yourself as many different types of valuations as possible, so you can then grab the best ones and then focus on how you're going to justify those valuations. So let's talk about an earnings-based valuation. Now, as you would have heard in an interview that preceded this lesson, Alan talked about a valuation tool that he'd created to assist him. And basically, his tool allowed him to explore a specific type of industry and input a bunch of questions that would impact the multiple that they recommended. And then once those questions were inputted and given a certain weighting, it spat out an estimated multiple which he could then apply to the Ebitda of a particular business. So here are some of those questions that Alan uses in his attempt to find the right multiple to apply to the Ebitda that he's calculated. So some of those questions are: what's the trend in the business itself? Is it up? Is it down? Is it stable? What's the trend in the industry? How skilled are your employees? How easy would it be to replace them? And what are the barriers to entry? So how hard is it to get into the business? Because if it's really easy, if there's not a really significant barrier to entry, it means there's an added risk of competition. People can jump in to that space at any time. So a business with a really challenging barrier to entry is going to be a lot more valuable, and that is going to increase the multiple by which he would calculate the valuation of a business. So let's see what I mean. Let's take a look inside the valuation tool and the exact valuation process that Alan and I use to come up with a price tag for my business, MPT. Because as I've said, and I'll say again, your job, or the job of your business broker, is to create the most compelling story for your business, to present it in the best possible light and to get you the most amount of money. Okay, so what we're looking at here is a revenue statement. Now, this revenue statement was created by Alan, our business broker, and it was created from our profit and loss statement. It's labeled Appendix 1 because you're going to find it at the back in the appendix section of our information memorandum that we created when we took our business to market. But we're going to go through this in really great detail in a later module. But anyway, let's take a look at some of the features here. So first thing you can see obviously is our income. So you've got 30th of June 2015. Now down here in Australia, our financial year runs July to June. So this is the financial year 2015, financial year 2016. And this was actually created in around February. So the financial year hadn't been completed. So we were going by projections, and we were projecting that we would do about $2.4 million in revenue, as opposed to the previous year we'd done about 1.8, and in 2015 we'd done 1.7. Now we decided against including 2014 in our marketing collateral when we took our business to market, because 2014 didn't actually look that great. As you'll see a little later, we had invested heavily. I think we just about broke even. So we decided to go, rather than 3 complete years, 14, 15, and 16, we went with 15, 16, and a projection for 2017. It just made the business look a whole lot better. Certainly when we got to the due diligence phase, people will have, and most likely I'm sure did ask about 2014, but this is what we went with. So you can see here we've got income, and we've got a breakdown of different sales channels, our corporate event sales, our Melbourne private tours sales, our travel representation sales. We had a lot going on. We'd started a range of different divisions to the business. So we've got our revenue there. That's all pretty straightforward. Next down, we've got our operating expenses, so the cost of sale, all of those costs that add up to form the service or the experience that we are running. And then we've got our gross profit margin here, which is pretty good at 44, 41, and 42%. Respectively. I always aimed to price our experiences using a profit margin of somewhere between sort of 40 and 45%. It just worked really well for our business, for the profitability of our business. And then we've got our business operating expenses down here. And these, again, as I mentioned, we're just taken pretty much straight out of our profit and loss statement. So over the next page, we get into the meaty part of it. Down here, where we are calculating our Ebitda and finally our Pbitda. So let's have a look at how we did that. So we've got our employment expenses, we've got our operating expenses, and then our Ebitda, our net operating income. So earnings before interest, tax, depreciation, amortization. Now, one unique thing to our business, we did have these government grants, and we had actually received these 7 years in a row, but we were not eligible for any more grants in the 2017 year. So you can see that we've listed the grant amounts in 15 and 16. So we did include them in these numbers, but we did include down here that we would not be eligible for this particular grant for a 9th year, although there were many other types of grants that the new owners may want to apply for. So we've got our Ebitda plus government grants, and then this is here where we added back our wages. So you can see we paid ourselves pretty well in 2015, $160,000. We took a little less by way of wages in 2016 and 2017. Therefore, we came out with a Pbitda amount as such, $432,000, $388,000, and $459,000 in 15, 16, and that projected 2017 numbers. So the next thing we did was punch this information into Alan's valuation tool. And let's go and have a look at that valuation tool now. Okay, so we're looking now at the valuation tool that Alan used to value my business. Valuation workbook, as you can see, just a Excel spreadsheet. Now let's have a look at a couple of the features. So you can see the first thing here that we've got the income for 2014, operating revenue 1.2 million, cost of sales 750,000, the gross profit. So the gross profit margin there a little lower than I ideally would have liked. Operating expenses, and basically the bottom line is that 2014 was added into this workbook just for our benefit, for comparison, but as I've said, we didn't actually include this in the information memorandum that we used to take our business to market. So we've got the June 30, 2015 figures, the June 30, 2016, and those projections there. And you'll see that these are pretty similar to the numbers that you saw in the information memorandum, but two noticeable differences here. One is in the workbook, he's actually outlined the add backs. So 40,000 close to in 2015, 63,500 and 87,000. These are add backs. These are expenses that a potential purchaser will not be inheriting. So we've identified those add backs so we can clearly see the additional value in the business for a potential purchaser, and those add backs can be reflected on the bottom line here of the Pbitda. So the other notable difference, you would notice that The EBITDA amounts for 15 and 16 are somewhat lower than they are in the appendix that I just showed you, the revenue statement. And that's simply because in this workbook, we haven't added in the amounts for those government grants, around approximately 60,000 and approximately 80,000. So that's why those numbers are considerably lower. We didn't use those government grants to inflate the EBITDA in this valuation tool. The EBITDA amount for 2017, as you would see, is exactly the same as it was in that information memorandum that we just looked at. That's because we didn't receive a government grant. So the only difference here is that the EBITDA amounts in the information memorandum are about 60 approximately thousand and about 80 approximately 1,000 higher than you see them here. So let's have a look a little further down. So the next thing that we can see here in this valuation tool, this valuation workbook, is a reference to the business reference guide. So that is a reference guide that a lot of business brokers, including Alan, use. Some have got better versions than others, use to get that market value of a business. So you can see he's looked at travel agencies, he's looked at travel wholesalers, he's also looked at general service businesses. So by looking at that business reference guide, he can get an idea of what thousands and thousands of businesses in those categories have sold for. And we can see here that he's coming up with a bunch of different multiples based on different types of businesses that his reference guide is telling us. So multiples here of 1.8 to 2.5 times EBITDA, multiple of 2.2 times EBITDA, multiple of 3 times EBIT. So a whole bunch of different ways that other businesses were valued. So he's got some historical data there, and he's then plugging those numbers of ours that we see here into different scenarios. So we've got a 2016 scenario, and it's coming up with a valuation of the business based on those 2016 numbers only. We've got 2017 projected numbers based on the multiples that those types of businesses, travel agencies in this example, were selling at. A little further down the page, he starts bringing those notes together and making it a little bit easier to understand. So you've got a possible valuation based on a straight line calculation, possible valuation based on weighted calculation, and on latest, whoops, that's a bit of a spelling mistake there, latest year calculation. So he's pulling all those notes together. We've got possible multiples that he has identified that other businesses have sold for. Here we've got the normalized financials that we've got here. Normalized, of course, meaning adding in all those add backs, all those expenses that were run through the business that a new owner would not inherit, and then based on these various scenarios coming up with a possible appraised value of the business. So based on EBITDA, we can see here, and a straight line calculation, that's a possible appraised value, 798. Down here, if we're looking at a weighted calculation, it could be 834,000. And if we're looking at a latest year calculation of our EBITDA, we could come up with a figure of 964,000. So a range of different variables, and he's taken it a step further, looking at the same type of calculations with a general service business, travel agency, travel wholesaler. So you'll get the idea in a second as to what he did with all these possible scenarios and all these different ways of valuing a business. So that was based on his business reference guide. The next part here is where he has cross-referenced those with the valuations that he's come up with his link valuation tool. And as I mentioned, the link valuation tool is that tool where he can punch in some questions with some numbers attached to those. So, a rating of 1 to 5, and it'll spit out, based on different types of industries, a possible multiple that he may use to calculate valuation of a business based on either EBITDA, EBIT, or PBITDA. And remember, we were focusing mostly on PBITDA. So going about it in a different way to the multiples that he got from his business reference guide. He has looked at potential multiples for travel agencies, for adventure tourism and just for travel agencies and for adventure tourism. So looking at it in a completely different way, he's come up with possible appraised values for travel agencies, some pretty underwhelming numbers, so not even $500,000, and for adventure tourism a little bit different. And we weren't really entirely sure what category my business actually fit into. There wasn't a great deal of historical data of tour operators selling, so we had to look around for different categories that it would fit. So adventure tourism and travel agencies were two that we felt were the closest fits. So if we were looking at adventure tourism, we're looking up here at in a range of 873 right through to just over $1 million based on a straight line calculation or a latest year calculation, whereas the numbers that we were seeing for a travel agency based on his valuation tool and the nature of my business were quite a bit lower. So we arrived at a broad range of valuations, looking at it and coming at it from a range of different angles, and you'll be able to get a good look at this valuation tool in the resource section of the program. And as I say, it's a little overwhelming, but it's just going to give you a sense of how thorough you could be and possibly should be when arriving at a valuation. And you need to take them all into account, because you're going to go with a number that you take your business to market with, and you want to have a number of different ways that you can justify that number. And hopefully, when you actually look at the valuation of your business in a bunch of different ways, you're going to start to see patterns that they're all sort of coming out in a relatively similar range. Obviously, the really low ones you're just going to toss out, but you're hopefully going to be able to arrive at a really good valuation in a bunch of different ways, which is going to really add weight to the way that you justify the price of your business. Okay, and the last thing we did, just so it's really clear and easy to understand, and we can look at it without confusing ourselves, once we've gone through all of these different scenarios based on a business reference guide, looking at the market value of a business or a market-based value. We've looked at the earnings-based value of a business. We've looked at it with a 3-year straight line, a weighted average, or a last year calculation, and we've looked at it with various multiples based on our Ebitda, and we've come up with a bunch of different possible valuations arrived at in a multiple of different ways. Then the easiest thing to do, and what we did, was just to stick it on a chart that we can look at really clearly to see where they all fell. So you can see on this chart that the possible appraisals range from there's a couple of low ones there that obviously we would throw out instantly that were in the sub 500 range, certainly a lot around that 800,000 mark, and a lot that pushed up towards the $1 million mark. So we could use these really strong appraisals to add weight to the way that we justify the price of our business. And as I say, anything that didn't fit with our objectives, we could simply scrap and run with the bunch of really good valuations and how we arrived at those. So puts you in a really, really strong position when interested parties start talking price with you and asking you to tell them how you arrived at a certain price. So that's the valuation tool that we used, and as I say, you'll be able to take a really good look at this. In the resource section, you'll be able to perhaps even punch in your own numbers or use it as inspiration to start working out how you might begin to appraise the value of your business. Right, so just to reiterate one last time, your job is to come up with the best possible valuation of your business, looking at it in a bunch of different ways, and then to focus in on how you are going to justify that valuation to an interested party.